it finally safe to circle back to the beaten and bruised cloud stocks? Regular viewers know I've spent years pushing these cloud-based software as a service names, but in the last few months, the group has been put through the meat grinder. Long-term, we've still got some tremendous and enormous gains here. In fact, most of them are still up for the year, and the Mad Money Cloud Kings have dramatically outperformed the rest of their cohort. Now, though, these former market darlings have become mangy dogs. They've gone from love to loathe as Wall Street lost its taste for high-flying growth stock.
Buy, 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 sell, 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 buy, 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 sell, sell, sell.
If you've been buying these stocks lately, it feels like you're volunteering to go over the top in World War I. I mean, you're begging to be mowed down by the short sellers and the long goers. At least until today. Today, when the whole group rebounded hard. Hey, so does that mean that the cloud plays have at last bottomed? Or is it merely a dead cat bounce as the sellers take a moment to reload? I think we've got a lot more reason to be constructive than we did a month ago. In mid-September, we conducted a damage assessment for you where I warned you that the cloud cohort had further to fall. I recommended dumping most of them and then circling the wagons around the highest quality software as a service companies, the ones with the most reasonable valuations, and I know they're expensive. Since then, there's been yet another downdraft, although it hit some of these names harder than others. To get this, on the average, the 11 cloud stocks I blessed last month, all right, they performed better. They're down less than 1%. While the 21 cloud stocks in our coverage universe, the ones I told you to dump, they've lost more than 6%. But let's zoom out and take the whole software as a service complex group by, let's say, do it group by group. We're going to start with the best of breed, the Cloud Kings. That's Salesforce.com, Adobe, Splunk, ServiceNow, Twilio, VMware, and Workday. Used to be Red Hat. Remember, that was bought by IBM. Their performance has not been very regal of late, frankly. On average, the Kings are down 21% from their highs earlier this year. While some of them have been slammed by the rotation, others have been hit for good reason. For example, Workday CEO Aneel Bhusri, whom I think is terrific, he warned just the other day that the company's, and I'm going to quote this, definitely seeing some delays, end quote, in the closing of deals at an investor event last week. The stock plunged from 180 to 160 in a day. Workday's now in negative territory for the year, highly unusual, by the way. Even the Cloud Kings with ironclad fundamentals have been poor performers. Salesforce, which you know is a Cramer fave, it's owned by the charitable trust, it's down 11.6% from its highs, and it's only up 8% for the year, significantly lagging the 20% gain for the S&P 500 over the same period. How about the cloud princes, the best run of the smaller software as a service plays? Think Coupa Software, HubSpot, Cramer family fave Okta, New Relic, Atlassian. They're like the Cloud Kings, but earlier in their life cycle with faster growth and smaller profits. The princes, they've been obliterated. They're down an average of more than 25% from their respective highs. Ouch! Coupa's held up better than the rest after today's rebound. It's only down 15%, which means the stock's still more than doubled since the beginning of the year. New Relic, Lucerne, which New Relic's an anagram for his name, it's the worst of them. It's down 45% from its highs, which has sent the stock deeply into the red for 2019. Some of these are really frustrating people. Atlassian, that's a business collaboration software play that I like so much. Just reported a strong quarter last week, yet its stock got hit hard on the news. And even after today's bounce, it shed 9 points since we saw those better than expected numbers. That said, most of the cloud princes had run so much going to the sell-off that they are still up substantially for the year. You know, we're talking 41% on average. Not bad, huh? Todd McKinnon, he's a beautiful headquarters building. Just a second. Deal with me. All right, here we go. Now, outside of the cloud aristocracy, the decline's been even more brutal. When you look at the other cloud stocks in our universe, and here's that list, Alteryx, Anaplan, Appian, Domo, isn't that like, they have a Domo in Florence and Siena. Domo, Five9, MongoDB, Paycom, RingCentral, how can I help you? Smartsheet, Viva Systems, Zendesk, and Heather Gaines' fave Zscaler. They plummeted more than 30% from their highs, with a big chunk of that pain coming the last month. That is painful. Same goes for the cloud stocks from the IPO class of 2019, sinking nearly 40% from their highs earlier this year. This has been a brutal sell-off underneath all the kind of just placidity of the averages. So these cloud names come down enough to be enticing. I'm going to put it in some context here. Do you know that we've seen these sell-offs before? Do you know that the cloud cohort got obliterated during the market-wide sell-off late last year? But that turned out to be a terrific buying opportunity. The same thing happened in early 2016 after a couple of extremely high-profile earnings misses from Tableau Software, subsequently bought by Salesforce, and LinkedIn, subsequently bought by Microsoft, not to mention a wave of software as a service IPOs. What can they tell us about the current situation? Okay, I'm not Fibonacci, but listen to this. During last year's meltdown, the cloud software cohort fell 32% from peak to trough over a period of 76 days. Compare that to right now. This group was now down 33% as of yesterday, having been hit for 103 days. In other words, based on the severity of the last big breakdown, you could argue the cloud stocks were ready to bottom coming into today's session. But before you get your hopes up, we need to consider the 2016 scenario. When you look at the cloud stocks that were publicly traded back then, they racked up an average of 46% decline from peak to trough. Even the best of them, Adobe, lost 26% of its value. It was truly a panic. While you still get an amazing buying opportunity, when you got an amazing opportunity, you had to be patient, wait for the carnage to unfold. Many people started too early. The question is, does the current breakdown look more like 2016 than 2018? Hard question. Well, okay, last year's meltdown had nothing to do with the fundamentals. It was all about a change in sentiment that made the investors ring the register in their biggest winners. The cloud crash in 2016, though, on the other hand, was in response to a pair of shortfalls, like I mentioned, Tableau and LinkedIn. You could argue they weren't connected to the cloud. Tableau is still an on-premise software provider. I mean, LinkedIn's a business-oriented social media network, but there was a real negative catalyst. I remember how much Salesforce went down on this stuff. Until last week, I would have told you the latest software as a service sell-off is a sentiment story, like what we saw in 2018. However, after what Workday said about the delayed orders last week, we need to be a little more alert for signs of actual weakness. That said, we also have got more reason to be optimistic after today's spectacular rally. Think about this. I think this run was all about the pin action from last night's unbelievable ServiceNow conference call. And let's face it, interview right here on Mad Money with ServiceNow CEO John Donahoe, even though he's moving over to Nike. I know it freaked people out, but, we got an able replacement, Bill McDermott. Terrific track record as the former CEO of SAP. Donahoe is well respected, so the fact that he's leaving the software as a service industry did make investors nervous. Of course. Fortunately, after the close last night, ServiceNow reported a fantastic quarter, and then both Donahoe and McDermott came on our show, gave us a very bullish outlook, said there was no economic sensitivity, confirmed that we all suspect there's no reason to question the drivers in the software as a service space. We also got a very good quarter from Microsoft, which has a major cloud infrastructure business that's on fire here. So I want you to put it all together, and I am now, tonight, giving you my blessing to pick at some of these downtrodden cloud names, the ones with the best fundamentals and the most reasonable valuations, the ones I've been worried about. That means Adobe, VMware, Salesforce, Splunk, Twilio, HubSpot, Five9, Zscaler, RingCentral, and Dynatrace. The bottom line, today the cloud stocks prove they can bounce, and after months of agony, even after this evening's Amazon shortfall, that may spook some because of its giant web services business, I think you can start gradually, not all at once, don't be a hero, buying the high-quality names right here. Just keep some powder dry in case they get hit once again, and we've got a 2016 scenario on our hands and not a 2018 one. Drew in Texas. Drew!
Hey, Jim. How you doing?
Drew, I couldn't be better. How about you?
I'm doing well. Got a question for you today. You talked about this stock a decent amount. I got some new news a couple weeks ago. IAC Corp. They're now finally planning on spinning off Match Group. Wanted to get your thoughts.
I think it's an incredibly inexpensive stock. I've always been a Barry Diller fan. I think that IAC, whenever this stock comes down, I don't know if you've noticed, we always cheer it and suggest that you buy some. And boy, am I ever not giving up on it now. I know that people were down when they kind of did the Match spinoff. This thing sells at an incredibly cheap multiple given all the different assets it has. I'm a buyer. Call me a buyer. I want to go to Patrick in Pennsylvania. Patrick.
Mr. Cramer, first and foremost, thank you for taking the magic out of the stock market and making regular people feel like they know what the hell they're doing.
Thank you. I just want to inspire enough confidence because everybody else is so busy trying to tell people what a bunch of dopes they are. That's never how I've taught, and I like to be constructive. How can I help?
Well, I bought into MongoDB.
Right.
My average buy-in price has got me at about $49.99. Closed today about $122 and change. Two questions. One, do I ring the register? And the bulk of my retirement accounts are bread and butter Vanguard index funds,
Very
S&P
good.
500, international
Very
stock
good.
market, and U.S. bond. So I ring the register and roll it over in there and go back to sleep, or do I keep buying in because they've been on a pretty good trajectory for about 26 months? They dropped off of their highs. Is now the time to ring the register?
You've got a lot. You've got a lot. I like to take out the house's money. So on this bounce that I'm predicting, I want you to take out a quarter of it and then put that in index funds. And if it keeps going back to its all-time highs, then you take off another quarter and then you just let it run. And congratulations, and thank you for the incredibly kind words. All right, the cloud stocks, they can bounce. You have my blessing right now, starting tomorrow, maybe on a little downdraft from Amazon, to start buying these high-quality names. Much more Mad Money at Centene is soaring after earnings. With the company building momentum through a series of acquisitions, is it time to consider the healthcare player? I'm talking with the CEO. Then, as worries about the global economy continue to make headlines, is it time to circle back to the utilities? I'm talking with the CEO of American Electric Power to see how that growth stock is faring. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.